Welcome to episode 49 of Kontrarian Korner. I'm Ben Kelleran. Today we have a very special guest on to talk with us about some of the recent chaos in the markets, some of the big picture, long-term trends he's seeing, and the U.S. starting to look like an emerging market, but a bunch of different topics from gold to treasuries to geopolitics. I think it'll be a fascinating conversation. So, Russell, thanks for coming on.
Oh, my pleasure. Thanks for having me.
Yeah, so I think it'd be a good place to start with maybe a little bit of your view that the US is sort of behaving like an emerging market where equities and bonds are becoming correlated. You're seeing wild moves in the last week from like equities skyrocketing. Yesterday, we're recording on Thursday the 10th, but you've got a lot of people freaking out, kind of a lot of doom and gloom going around in the last week. But I'd be curious to hear you explain a little bit your thought on the process of the U.S. becoming an emerging market.
Yeah, absolutely. So look, I think you need a little bit of financial history, and you follow how global finance has developed since World War II, then it's much easier to understand where I think we are at the moment. So, after World War II ended, we had a big reconfiguration of the world. The US became the center of the world. Financially speaking, taking the mantle from what really was the UK before, completely. And we still had this sort of, everyone was pegged to the US dollar, but then the US dollar was pegged to gold, more or less. And we moved to a sort of different way of running the world, and we went to what I call a pro-labor one. So the governments were very pro-unions. They tried to push wages up, and they spent aggressively to try and keep growth going. That was the model that we had from, I'd say, 1945 through to 1979. And the thing about that model is it worked for a while. It actually worked until the US sort of basically ran out of oil. So when the US started to import oil, as it was growing, it was running these bigger and bigger trade deficits and had to send gold overseas, right, to Europe mainly and Japan. And was basically sort of going bankrupt. And at that point, Nixon left the gold standard because he didn't want to send any more gold out, and he thought he could get interest rates lower again. But because he essentially defaulted on a U.S. liability, interest rates went to the moon, dollar collapsed, gold went up a lot. So it's the first really mega gold bull market. And then what we saw was a new system emerge from that. And that system was Treasury yields were pushed way up by Volcker, and the US adopted more free market policies, and governments actually reduced spending. And so the US was really good at convincing other countries to buy treasuries rather than gold. And the US ran very sensible policies. And what you saw was gold actually underperformed treasuries massively. And if you think about it, it's not that hard to understand because gold doesn't give you anything. It yields nothing. But if you bought a long-dated treasury in 1980, you're getting like 15% guaranteed by the US government. And at that point, under Reagan, they're running very sensible policies. And what's happened over the last sort of, I'd say 2 to 3 decades, is the system morphed into US allowed China to export to the US, Japan, all these other Asian nations. And they ran up these huge surpluses, which they then reinvested back into US treasuries. And so it allowed the US to run a much bigger fiscal deficit than you would normally expect because people just got into this habit of buying treasuries with their spare cash from export earnings. Part of that was to keep their currencies weak, and we saw this huge buildup in sovereign wealth funds and other things. And so that was the way I understood the system. And the thing that worried me about Trump was that what he was trying to do is he wants to get rid of the trade deficit the US runs. So he doesn't like how the US imports from other countries. And I'm fine. If that's what he wants to do and he wants to, increase the wages for domestic workers, that's a great policy. The problem is if foreigners aren't earning US dollars from their exports to the US, right? They have no dollars to recycle back into treasuries. Now, that's not a problem if the average American worker saved all their money, put it into the bank, and then the bank bought treasuries. That wouldn't be a problem. You're literally just transferring from one set of owners to another set of owners. The only problem you got is the average worker in China or Japan only gets like 1 or 2% on their savings, but they're not really given a lot of our options, so they're okay with that. American investors, historically speaking, I'm sure this is true for you, Ben, and most people hate fixed income, only want equities. And so what you're doing is you're moving away from natural buyers. So from the free market terms, Asian investors were very happy to buy treasuries, and the US was supplying them. And Asians were very happy to build cheap equipment to then sell to the States. So it was a really win-win situation. I think what Trump was trying to do is he's trying to cut the Asian workers out of the American economic system, but still managed to get their capital in to keep interest rates low. If that makes sense. And for me, there was always this sort of dichotomy or oxymoron. You can't actually conundrum, if that's a word, where you can't do both. You can't cut out the world from exporting to the States and rely on them to buy treasuries and keep interest rates low. And that for me was always the risk. What I felt was maybe they use the Fed to buy treasuries to plug that gap, but investors would take that very negatively and pile into gold. Or alternatively, people would start to perceive US treasuries as an unsafe asset and treasury yields would skyrocket. And then you could perhaps get an environment where gold goes up and treasury yields sell off. And I think in the last few days, particularly since Trump announced his Liberation Day tariffs, we've sort of seen that come to fruition, if that's the right word. Anyway, that's sort of what I'm seeing.
Yeah, no, it's definitely been a chaotic week on a bunch of fronts, but I want to pull a little bit on that thread of like treasuries potentially not being a reserve asset. I know you've kind of talked about the path to like double-digit yields. I think that eventually that's where we're headed. It's either that or yield curve control, in my opinion. But I'd be curious to hear what you have to say on like where like they're kind of stuck between a rock and a hard place. And there's a couple different choices and none of them look all that attractive. But what do you think the path out is from here? Because I know a lot of people think they'll just inflate, but I mean, there's multiple ways to address it, but none of them are particularly pretty.
Yeah, I do sense a lot of people fear the markets and fear what's going on. I think it's easier to understand markets in terms of trying to get back to a balance and harmony, if that makes sense. And I think one of the upshots of policies we've had in the last few years is that asset prices relative to incomes are really got out of whack, if that makes sense. So I know this is very true in London, where I live, and in parts of the US where the average 20, 30-year-old feels like they'll never own a property because property prices have just risen so much. And particularly in the UK, I know that there is now a sort of political consensus about trying to get house prices more reasonable. So there's two ways of doing that. One is you could collapse the housing market, but we've seen that that's not a great outcome. It creates high unemployment and other issues like that. So I think where we're going and what the political winds are pushing for is that we try and get wages to rise significantly. And we're already well on that process. Wages have risen a lot since COVID, for example. And what we try and do is we try and keep asset prices in check. So just using some rough numbers and looking, I'm old enough, sadly, to remember when interest rates used to be 12, 13% in the early 90s. I know I look much younger than that, but it is true. So, I just sort of go, okay, if I'm a, let's say I'm a populist politician, and there are a few of them around these days. Let's say the sort of rough numbers they're looking at is if we can get 7% wage growth annually, right? That will double wages or incomes from where they are today. Okay, so that will help with house affordability as long as we don't let house prices get out of control. So we need to be attractive enough on the interest rate market to stop money flowing into assets. So what I put that down at is around like a 3% real yield. So if you're getting 3% over what inflation is, you'll probably be, okay, I'm going to stick my money in the bank rather than go speculate in the housing market. So taking those two numbers gives you a 10%, right? Now, that will feel, let's say you're a private equity guy who's bought a terrible business on 3%, corporate loan. Going to 10% will be terrible for you, and you will lose a lot of money as a private equity executive. No one really cares that a private equity guy goes out of business and loses a lot of money, other than that private equity person. They never really added any value to society anyway. And so they will complain about. But for the average worker and for most people, growth should be very good. And that's what we saw during COVID, is that when you give people higher wages, growth tends to be very good. And that's where we're trying to go. We're trying to get the nominal GDP to grow a lot so that we have the GDP to pay down the debt, to get asset prices into check. And I think this is a thing I've really learned over the last few years. So only taking me 45 years or so to learn this, because I'm a slow learner, is that everything is political. So what we're seeing today is this sort of political drive to try and rebalance. And so I'm not going to, I won't commit to this is going to be like this forever. I'll commit to it while the politics is supportive of it, if that makes sense. And so once we've corrected the imbalances of asset markets, then markets can do what they've been doing before. But these imbalances do need to be corrected one way or another. I hope that answers your question, but I went a bit philosophical on you, but hopefully that's okay.
Yeah, no, I think you do see chatter as far as real estate where people are talking about, okay, what happens if you work on immigration, fix some of that, or if you regulate institutions and like BlackRock, Blackstone, guys like that from buying single family homes. Because if you look at like their percentage ownership, it's basically straight up and to the right since 2008. And that's, I think, generally a negative thing. But how that gets done is kind of up for debate. But I think there's no reason that unless you want to live out in the middle of nowhere, that a house should be like 10 times median income or whatever it is in some of these places. So I think that's one of the things that I think will be interesting to see. But you kind of mentioned like private equity, private credit, and I do want to detour there a little bit. And I'm kind of looking at it as there's a lot of toxic sludge in that whole space. And I think it's kind of a ticking time bomb, but I want to see what your thoughts on that are, because there's a lot of chatter about that, like how are they going to offload these assets? A lot of endowments and pension funds and other investors, like big institutions, are in these illiquid investments. Like, where does that lead?
Yeah, it's a good question. I've been talking to guys about. I think the issue of private equity. So, I think Trump is sometimes on the financials of how he does things is very inconsistent, as we're seeing with the tariffs over the last week. I remember when he was first running for election, he was talking about taxing private equity, getting rid of the carried interest loophole and stuff like that. He didn't do anything like that when he was in power the first time. And what we saw is also a lot of the tax reform was not great. It allowed the private equity industry to do even, and also some of the big tech companies to move even more income to tax remote locations. So what you saw was a huge growth in private equity from 2016 onwards. And so I think for a lot of big endowments and asset allocators, they went from like a maybe 5 or 10% allocation to private equity, private credit, to more like 20%. And now the problem they've got is that if you got bonds selling off and you got equity selling off, right, that will naturally push your allocation to private equity above that sort of 20% threshold. And this is a problem I've seen personally firsthand. Back in the old days, when I was short, like in 2008, you would be getting redemptions even as you were putting up absolutely massive numbers, or good numbers, and you'd be calling up this investor who you'd get along very well. You go, why are you redeeming from me? He goes, I have to, because you're now too big in my portfolio. Everyone else has lost 30% and you're making like 10, 12, 15%. You've now pushed through the top side of my allocation sort of budget, and so you get redeemed. I think private equity is getting redeemed, but I think they're getting redeemed for a different reason. In more that if they were honest with the numbers, they would probably be shrinking as fast as the rest of the market. But they are paid to apparently see through the volatility. And one of the things I found extraordinary about private equity, private credit. So I was in New York last month. Yeah, last month. And just talking to some big investors, allocators, and that sort of thing. So they said basically the IPO market has frozen up, and the private equity guys aren't getting any exits. And I said, well, the S&P is at all-time highs, right? Credit spreads are at all-time lows. So why are they not doing IPOs? Well, how can the market be frozen? And this is pre-tariffs. How can the market be frozen? And the reality is they sort of refinanced a lot of things that during the COVID lows of 2021 at super low rates, and were super unwilling to lock in a different valuation using current interest rates. And they were sort of sitting there praying and hoping that the Fed would come in and bail them out again and push rates back to levels where they can refinance at a high level. And I think it's sort of like an open secret, and given how until recently bonds were always trending lower, yields were always trending lower, maybe they could be right, you would be thinking. But I think if we look at what markets are doing today, the hope and dreams of private equity executives look more and more remote to me. And so there will be a working out there at some point. When, I don't know. But there certainly seems to be some give. I don't know. So did I answer your question, or do you want me to be just more super bearish? I'm just telling you the
I think
problems.
that was what I was looking for. I would just add the news I saw recently that Harvard is borrowing like $750 million. And I think that's, they say it's federal funding, right? They supposedly have some massive endowments. So I'm curious to see how that plays out. But it is interesting to kind of see the whole private equity, private credit, like the private credit side especially has been talked about for the last handful of years as like hot new asset class, all this stuff. And I kind of look at it as like, well, there's when they start trying to put that into public vehicles so retail investors can have access, you see stuff like that. It's like that's generally not a good sign. So I think it'll be definitely something to watch. But to go back to treasuries and your kind of thoughts there, I know you've talked about gold versus TLT, gold versus S&P, and the kind of trends there of, okay, this is not like a indefinite thing, but for this cycle, you're going to see gold massively outperform like the long bond. And that's continued to play out. It's continuing to play out today. So I'd be curious to hear, I guess, what your thoughts on that potentially ending, like what it would take for that to stop, or if you think it's pretty much a one-way trend unless there's some massive changes to this point.
Yeah. So look, there are a number of factors that have fed into this gold versus treasury trade that I like. So I think one factor which precedes this a bit, going back to sort of 2022, is when Russia invaded Ukraine, they froze the assets of Russia, the treasury holdings and reserve assets of the Russian central bank. So, why I think that is a good decision. That makes sense. It was good that they tried to put pressure on Russia. It does mean that, you suddenly, as like a central bank or a sovereign wealth fund manager, you go, should I really be leaving my money in treasuries? Will I get those treasuries back? Will I be able to use them? Should I be using the money for something else? That would be a big concern. And certainly like China, who has the world's largest foreign reserves, must be thinking, why would we own these things? And certainly they've been trying to sell them. And they certainly have been buying gold. And so there's this very logical very logical way of thinking about it is, okay, most central banks will probably be reducing or selling their treasury holdings. And then the problem with that, if you follow that logic on, it's not like, oh, okay, I'll sell my treasuries and now I'm going to buy another country's sovereign bonds, because that's the same problem, correct? So you end up with, well, what do I do with this money? And there are two things they could do to solve that problem. Is one, rather than build up foreign reserves, they could go out and spend that money, which is actually, I think, what Trump wants from a lot of his policies. He wants countries to stimulate, and they have responded to that, because if you can't export your way out of growth, you have to stimulate your way out of growth. So that's why we're seeing bond yields rise. And the other thing is you can put into gold, which was before treasuries was the only really reserve asset. So, a lot of the politics of the world, both domestically of trying to push up wages and internationally about a lack of or breakdown of trust between nations, all point to gold doing better than treasuries. Now, this can end as it ended back in the 70s when the US looks to rebuild trust with its partners. And to rebuild its trust with its partners, it needs to not put up tariffs. It needs to honor its security agreements, like with Ukraine, for example. And it needs to show real determination to do something about its budget deficit. So, back in the 70s, US regained the trust of the financial world by having Volcker as central bank governor, who put rates to like 20%. And, a Reagan who came in and, really slowed down the growth of spend and the rise of like minimum wages and other things like that. Now, for me, Trump is more on the sort of populist politicians of 50s, 60s at the beginning of that trade, not a Reagan at the end of that trade, because I think the political winds that are flowing at the moment is more to get wages and asset prices back into alignment, if that makes sense. And the easiest way to do that is to push up wages. And I think that's what the whole tariff thing is all about.
Yeah. So as far as gold S&P, you think that trend also kind of continues? I know that's been an interesting chart to kind of take a look at as far as a ratio standpoint, especially over the last, call it 6 months. But do you think that kind of does the same thing in the next handful of years?
Yeah. So look, intellectually, so I started out as an emerging market fund manager. And the thing about emerging markets that made them really easy and really fun was like, if you thought the government was in trouble, everyone was in trouble, if that made sense. So, and actually, if you thought the big corporates were in trouble, and the government was also in trouble. So if you looked at like Mexico or Brazil, you thought Petrobras or Pemex or was in trouble, then you knew the Brazilian government was also in trouble. Now, it used to be like with the States, if you thought the corporates were in trouble, like so pre-GFC, if you thought, okay, all the banks here are going to fail, yeah, you could buy the treasuries and they did fine. That makes sense, right? There was a different type of relationship. You could have the corporate sector be in trouble, but US governments were safe. So that was for me always a distinction between an emerging market and a developed market. And we used to sort of think that distinction was driven by, could they borrow in their own currencies or not? So Mexico and Brazil did a lot of dollar borrowing. So that's why there was a connection there. But I think what we're starting to see, and I think the Fed really went wrong, it started to go wrong under Ben Bernanke. I think he has definitely made a huge number of mistakes, and they become more and more apparent over time. He probably should give back his Nobel Prize for economics if he had any shred of integrity. I don't think he does. But what we saw was, like, after the dot-com bust, the governments came to guarantee more and more of the US corporate sector. So we saw this, and with Elon Musk as well, we're seeing this merging of government and corporate. And so now what we're starting to see is that US corporates are fantastic businesses, but they're starting to suffer as the US government suffers as well. And this is what we saw in the 70s. So at some point, there'll become a political discussion of how can we make the US government strong again? And that will be through them running a balanced budget, raising taxation, particularly on corporates, and rich individuals, and becoming much more responsible. I know a lot of people out there might think Doge and what Elon Musk is doing with Doge could balance the budget. So as a foreigner who's looked at a lot of different countries, when you see an austerity drive that actually fires tax collectors, that is a very unserious austerity drive, if that makes sense. That is not being sensible. That is being ideological or dogmatic. If you're really serious about balancing the budget, you actually hire more tax collectors as a rule. I know it's so self-explanatory. I don't know what else to say about it. So I think that is where a lot of the current market conditions are coming from.
Yeah, I do think to your point on Doge, if they really want to like cut back on spending, you kind of have to look at Social Security, Medicare, Medicaid, and I'm not sure how much fraud would put a dent in the deficit, but I think that's going to be or could be a lot more than say, okay, we're cutting these handful of government agencies and seeing where that goes. So the other chart related to gold that I think is pretty interesting right here because they're both commodities is gold to oil. And I was taking a peek right here, and I think it was like 1 ounce of gold can now buy 53 barrels of oil, somewhere in that ballpark, which is right. If you pull out oil going negative, it's basically an all-time high. So I know it's not a timing indicator, but oil is kind of one of those things where I think it's pretty interesting. It's not an asset that can be printed like bonds. So I'd be curious to hear your thoughts on if that chart eventually starts to reverse. I know there's a lot of sharp people that think it continues to blow out, but I think it's at least something that I find really interesting. So.
Yeah, look, it is interesting. I must say, I thought probably the oil market's more supported, but and OPEC did do the surprise cut. I personally thought oil would do a bit better, and there's still potential for it to do well. My reading on the very short term anyway, so I thought Trump was going to do something more with Iran, which would put at risk their production. That being said, the shale oil has really changed a lot of dynamics in the energy market, and so one of the other ways I look at energy markets, which you can't really do over the long term because it doesn't capture this change, is that it used to be in the US. The US was the marginal consumer of a new barrel of oil. It was the biggest importer of oil, and oil was the main sort of energy source. Now, what I think the world is moving to, and maybe that's a better way of looking at pricing, is that the price of LNG into Asia, right? So that is a big growth market. Most of the people in the world live in Asia, and Asia is the biggest importer of LNG. Now, in the old days, LNG in Asia used to just be priced off the oil price. It now has its own market, if that makes sense. And it was, until very recently, at $16, which compares to $4 in the States. It was $16. So as a rule of thumb, you can say sort of 10 times that gives you an oil price. So LNG in Asia was about 160, which made oil look very cheap. And what we've seen is that LNG price in Asia has fallen back down to about 11. So the market is priced in some sort of recessional slowdown. And 11 sort of equates to 110. That'd probably be more closer to where gold is trading. It's just very difficult to get those numbers right because you have to. So $11 if Asian LNG actually translates to about $4 or $5, which is what the US price is today, because of transportation costs and other things. So what I'm trying to say is crude oil may not be the right measure anymore, partly because we're moving to a more electrified world, if that makes sense. We've got more oil. There's actually natural gas and LNG are the right markets. And when we look at those markets, the picture is a bit more nuanced, and it's trickier. It's a trickier one. That comparison's more difficult to make than it used to be.
Yeah, no, it is. There's definitely a lot of moving pieces, and I find it kind of fascinating to see kind of what's going on right now. But with you look at the Permian in particular, I have a really hard time seeing how like the recent sell off of, I mean, we're under 60 right now as far as WTI. I have a really hard time seeing how Permian production grows at this point, and eventually, I do think it'll be a point where if demand kind of keeps growing 1% a year like clockwork, and supply is going basically going flat, then eventually that starts to play out, whether it's in inventories like we've been seeing. But I think it's one of those things where it seems like it's kind of disconnected from physical markets as far as financial market price, but that's kind of a separate rabbit hole for sure. So you did kind of mention Iran and some of the stuff in there as far as the geopolitical side. I think that'd be a good segue to talk about that, because I've been kind of following it just as just one of those things that like I'm a little bit nervous about, where you see, okay, the U.S. is moving like B2s to Diego Garcia, and there's an extra carrier group staying in the Middle East, and all these other headlines where like they're clearly moving material into that region of the world. You've got Israel, right, doing their thing, which is another rabbit hole for sure. But I think there's definitely factions within the U.S. that are wanting to kick things off with Iran, but I don't know if you have any thoughts there, and then maybe we can shift to Ukraine after that. But I think the Middle East is, I think there's significant potential for chaos there, and not just like, oh, it's out a year or two, like pretty quick here. So,
Yeah, I mean, so the world, to put sort of everything into one answer, the US used to have a sort of very fixed view on how it wanted the world to look like and behave, which was basically it wanted everyone to become democratic. If you became democratic, then the US would let you do free trade with them, and they would have your back if like an autocratic nation came in to get you. The probably big exception to those rules was the Middle East, partly because the US had to import so much oil. So OPEC sort of taught the US to leave the Middle East alone and try and we sort of restrain Israel to a degree, because that's really where the 70s sort of inflation crises came from, with big disagreements about, a lot of the oil producing, oil exporting nations really disagreeing with US policy regarding Israel and Palestine. And so the whole shale thing has sort of taken away a lot of OPEC's ability to restrain the US. And now, with a sort of the Trump administration and his views on how the world should operate. And certainly, what we're seeing with Ukraine was definitely a democracy. It was definitely invaded. It definitely wanted to move to sort of free market type operations, and also had a security guarantee from the US from the 90s when it gave up nuclear weapons after the collapse of the Soviet Union. So, these conditions would all make you think the US would be strong ally of Ukraine versus Russia. And what we saw with Trump and Vance is that's not the case. They're looking for sort of an easy win there, where the only possible way to quickly resolve that war is to allow Russia to keep the territory that it's conquered. And that's a huge wake-up call, I think, for the rest of the world. And part of the reason why you're seeing some dramatic changes in treasuries and even currencies today are having big moves with the dollar very weak is that the system that, and this is why I always found Trump hard to understand, is because the system that makes the US so much more wealthier than the rest of the world was based on these security guarantees and other things. And he was so adamant that he wanted to get rid of them. It seemed to me like he wasn't thinking about what the negative consequences of those actions potentially could be.
yeah, no, it's there's definitely some nuances there. It's hard to look at what the potential outcome is if we start to pull back from Ukraine, and hopefully, I think, pull back from the Middle East. But that's good luck doing that with some of the donors here in the U.S. But as far as Ukraine, the thing I find interesting is some of the rhetoric out of Europe about remilitarizing. I know you've talked about Japan remilitarizing as well. And like I kind of basically said, yeah, I'm nervous about Iran and the Middle East and what the U.S. has planned. I know they're already right bombing the Houthis in Yemen, stuff like that. But as far as what the Europeans might do in Ukraine, there's definitely been a shift in rhetoric out of kind of what you see, at least what I see on the Financial Times and some of the mainstream media outlets in Europe. But where do you think that heads as far as Europe remilitarizing? I know they're talking about spending packages and all this other stuff. Where do you think that leads?
Well, look, the US was always very anti-US European remilitarizing. In fact, the Japanese and German constitutions almost explicitly ban them from having any offensive capacity whatsoever. And those days are gone, to be honest with you. And so it leads to, and again, it leads to sort of a very inflationary view, is that basically, armies in Europe and Japan will have to be rebuilt. The supply lines will need to become secure. And that's for a lot of different products. So one of the things I would expect to see is that you need to build, at the moment you have a lot of supply lines muddied. Now they need to be all secure and internal. So if you can't be really relying on, so what we saw of the Ukraine-Russian war is both sides were using Chinese drones to attack each other. If you're going to be potentially fighting China, you can't fight them with their own drones. Well, you can if you want to, but it's not a recommended strategy.
Yeah, good luck.
Yeah, you're definitely going to find your supplies sort of running out sooner than the other side. And so, what all of that implies is, like, if you think about the sort of globalization world, is that wherever was the cheapest producer, everyone bought from that. Now it's going to be like, oh no, I have to buy from this US producer, which gives them more pricing power. And then you're actually duplicating the process 3 or 4 times for each different nation. So we're moving to a world that's much more inefficient, and where we're already at very, very low unemployment rates as it is. I'm sort of struggling to see where you're going to get all these people from, to remilitarize these armies or to build up personnel again. Everything leads back to a very inflationary environment, if that makes sense. I guess this is the thing I'm trying to say in a very simple terms. Globalization is great for the states because the states always wants to grow and grow without any restraint. I mean, it's the American ideal, is like, no limits on my freedom, no limits on my credit card, no limits on my gasoline consumption. That is the American way of thinking, and the world is better for it. The problem, of course, is that when no one saves, you have to borrow from someone. And the great thing was that the Europeans and the Japanese loved to save, and they will love to lend it to the US. So that's a great, great system. But now, by forcing the Europeans and the Japanese to build their own armies and to not be able to export to the States, they don't have money that they can lend to the US, right? So the US growth model, which is credit driven, looks sort of dead in the water to me. It's now moving to a new sort of wage driven model. But if that's going to be bad for margins, it's going to be bad. I mean, interest rates going to be higher. So it's really bad for corporate America. Whereas I think growth will be very strong because you have the entire world stimulating now rather than just the US. But it just means interest rates will be higher and assets will struggle to move higher from here in real terms, in my view.
Yeah. No, it is interesting to see the trend of kind of deglobalization versus what's happened over the last 30, 40 years, because I think that's at least a durable thing for, say, 5 or 10 years, depending on how some of these geopolitical things play out. It does make it less efficient as far as kind of looking at it from a top-down point of view, but I think that'll be something that's here to stay. But I think one of the threads I wanted to pull on was the potential for an inflationary or stagflationary cycle. I think to really see that take off, you need oil and some of the other inflation sensitive assets that like flow through to the real economy start to pick up. But I think that's something where it'll come in waves, and we obviously had one wave a couple of years ago and it's died down a little bit now, right? CPI was low this morning. People are talking about it and celebrating, but I think over the next couple of years, inflation is probably going to start to trend back up again, especially with all the chaos, all the different changes in policy, all these different things going on. So I'd be curious to hear your thoughts on if it's like, is this going to be repeat of the 1970s, a little bit different? What things are on your radar as far as inflation versus stagflation, how that might play out?
Well, you got to remember the 50s and 60s were golden years for the US. There was strong growth, strong wage growth, the growth of the middle class, huge growth in normal GDP. It was only once you had this sort of US became a big oil importer and then that got restricted that inflation really, really took off. And so what we're seeing at the moment is US growth is still pretty good, but oil price very low because there's plenty of oil out there. Where I could potentially see the type of scenario I think you're trying to hint at, like a 70s type blow up in commodity markets. I can give you a story, but it's a story. Okay, but I'll give you a story. And I see some signs of it. Whether this is what's going to happen, I don't know. But this is what I see is that, generally speaking, the reason oil prices are so low in the States in particular is that when the U.S. shale, particularly the Permian region, produces a lot of oil and gas. So when you have either oil or gas is doing all right, the Permian producers can make money. And natural gas prices were doing very well not so long ago, so they produced too much. Now, I think Trump expects deregulation to grow that production. But from the numbers I see, production is really falling or stagnating for natural gas production in particular in the US. So if you look at like the Appalachians, it's sort of down. Now, where I could see a potential spike in energy prices is I think there's been a lot of new LNG export capacity has been authorized, which had been slowed down by the Biden administration. Now, if you can bring on another sort of 10 million, I forget the units they use for LNG.
BCF?
Something like that. I think it's around about 12 at the moment. They won't bring another 10. I have to go check my notes. Basically it's about 100 BCF, 100 BCF production. Most of that's domestic, but you have about 10 that's exported. Now, if they boost that to like another 15, 16, which I think is what they're talking about, you suddenly go from being a very loose natural gas market to a much, much tighter natural gas market, which would then have effect globally, as the US is like the swing producer in LNG exports. Qatar and Australia produce a lot as well, but the US is a big sort of swing producer at the moment. So what I'm trying to say is that the reason US energy prices are so low is this natural gas is sort of actually trapped in the States. It can't get what it should get overseas. And if they deregulate the export market there, you could see US natural gas prices spike from the sort of $4 long-term number that they've been for a while now to something like 8 or even 10. And then, you get a big increase in inflation expectations. The other thing I would say is that despite energy prices low, what we're starting to see is the cost of electricity is going up in the States quite significantly on data center usage and also restructuring the grid system so it can cope with solar and wind generation. So even though the commodities, which is what we normally look at for inflation, have stayed quite stable, the system by which we connect to the electricity network is becoming more and more expensive. And so you may get the inflation shock that you're thinking about. It just won't be in the same place. It'll be in a different part of the energy stack, if that makes sense.
Yeah, no, it is interesting because you see, like you're saying, some of the stuff with gas production. I know the Permian is getting gassier and gassier over time. You have like the high decline rates in there. So I think it'll be interesting to see what happens over the next 3 to 6 months after kind of the last couple of weeks. Because I kind of follow a couple Twitter accounts of guys that are like oil hands, like on the ground in Texas, just for kind of a sentiment read on what they're seeing. And I have a hard time seeing how there's going to be a CapEx boom in the Permian and like they're going to be able to maintain production at 59 a barrel or whatever it is. So I think it'll be interesting to watch, but I will be curious to see if you're right that sort of plays out more through natural gas versus oil itself. But as we're starting to wrap up here, I do want to kind of pick your brain on China a little bit more, because I know that was kind of, I mean, it's become pretty clear now after the 90-day pause and was 125% tariffs on China that like they're the target of kind of Trump's recent moves and the tariff chaos. But where do you think that leads as far as like what happens to global bond markets, what happens to trade between the two countries? Because the way I kind of view it is the two economies are tied at the hip, and the U.S. debt markets need China as much as China needs U.S. consumer markets. And it's kind of like this tug of war that's obviously going on right now. But how do you kind of think about the big picture regarding U.S. and China?
Yeah, so it's so complicated. So I used to live in China. I lived in Hong Kong for a year and used to go up to southern China back in the 90s. And I did a degree in Asian studies back at uni. And one of the things I found very amusing was, as I traveled from Australia to the UK and then used to have US clients, was the further you got away from China, the more sure people they knew what was going on in China. So anyone in China had no idea, but you get to the States and everyone knew exactly what was happening in China, which I always found quite amusing. So the problem with China, and sometimes it is self-obvious, but sometimes it's worth explaining to, just reminding ourselves. China has like 1.4 billion people. So that would be like, Europe, the US, Japan, South America all jammed together. And to sort of try and, if you think about that many people and what's going on in a state of that size, trying to get fully on board with what politics and what's going on is very, very hard. Now, China has some big advantages over the US. And one of those big advantages is basically it's had nonstop reform for the last 40 years. And what I mean by that is like they're constantly changing the laws, they're constantly rebuilding infrastructure. So it's a populace that's very used to big change, if that makes sense. And you certainly see it in like their adoption of technology. They have a very different payment system to the West. They don't use Visa or MasterCard, for example. They use QR codes. They've been much more aggressive in the adoption of electric cars. They seem to be much more aggressive in the usage of AI in everyday life. And so you got lots of things going on there. So it's really difficult. China could do very, very well from what Trump is doing, because it may push more and more nations into Chinese orbit, if that makes sense. So, for example, Vietnam, which after the Vietnam War became a close ally of the US and has traditionally been very hostile to China, so it would be a natural ally for the US, has just been slapped with like 74% tariffs, or by Trump. And so, how does that happen? And Vietnam's 100 million people. You think it's a small country, but it's 100 million. It's large. So what I'm trying to say is that you've got a lot of moving parts that make it very hard. China looks interesting. Stock's cheap. They've definitely got the technology. My big worry about China from an investing point, because I know a lot of friends along Alibaba and those guys at the moment, is if China did something with Taiwan, do you suddenly get huge sanctions that force you to sell your Chinese assets at a big loss? And is really, really hard to know. All I do know is that China has really been a force for reflation because it chose not to devalue. And it's sort of where the original GLD, TLT trade idea came from. So I do keep a very close eye on China, even though I've just said I have no idea what's going on. Occasionally, one of the great things about the Chinese government is occasionally they come out and tell you what they're going to do. and they almost always do exactly what they say they're going to do, even if the market doesn't believe them.
Yeah. No, I have a friend who calls that fear of getting Gazpromed after what happened with Russia and their
Exactly.
markets and far
Yeah.
as U.S. access to it and all that. But I do kind of wonder with kind of the 90-day pause on everyone but China, if they kind of move towards a negotiation stance of, hey, like we'll walk tariffs back to 10% or like whatever it is, 10 or 15%, but you guys have to cut that shit out with the fentanyl. You guys have to basically back off on the Panama Canal and realize that it's kind of the Monroe Doctrine type idea that the U.S. sphere of influence is going to be the Americas, and we're not big fans of some of the moves they're making as far as like influence in the Canadian government and what's going on in Panama. I think the Secretary of Defense is down there in Panama right now, but I know that's a very important like geopolitical location for the U.S. And I think if you kind of get some resolution there, I wouldn't be surprised if that's one of the kind of big picture motivations of, hey, we're going to really target you guys with tariffs. But I don't know if you have any thoughts there. I think there's a decent chance that it's not just the economic side that is motivating the 125% kind of punitive tariff on China.
Yeah, it is very difficult. So if you take a look at China, right? So U.S. in the 70s became a big oil importer, and then the U.S. has changed its behavior to try and secure those supplies. So you often when Iran invaded, when Iraq invaded Kuwait in '91, it's probably before, you probably don't remember that, but the oil price went up, and George Bush Sr. sent the U.S. Army in to kick them out of Kuwait to get the oil price back down. And they had to do that because the U.S. is the biggest importer of oil, and they needed to keep oil prices low. China is now the biggest importer of oil and commodities, right? And so I understand what you're saying about sphere of influence, but it's very difficult for the Chinese government to just sort of say, okay, we're not going to be involved in the Middle East, for example, even though we are the biggest buyers of oil, or we can't be involved in Brazil because that's in South America, when we are the biggest trade partner of Brazil by quite some way.
Or Venezuela for their oil.
Yeah, and that is where it gets tricky, because and the problem, as I think I'm trying to get across as a non-American who's only lived in American allied countries, Australia, Japan, and the UK, is that Trump has managed to bring about a huge loss of trust in the American government, and by extension, U.S. treasuries. Because he didn't step up to, fulfill what the US has historically filled. That's, of course, a choice. The UK did the same thing back in World War II when it didn't defend Singapore and didn't send troops back to Australia. And so after World War II, Australia became US allies, and we sent troops to Vietnam because we saw who was out there who could protect us. And so when you don't step up, then people have to find other ways of dealing with their own issues. And so, the talk in the rest of the world is, do we have to do a deal with China? It's not, is the US going to break China in half? It's more like, we probably need to get some leverage over the US these days. And the only reasonable way to do that is to have a discussion with China. Not necessarily do anything with them, but at least open those channels. Whereas US, prior to Trump, everyone was on board and trying to keep China under wraps. I think that's why I think a lot of what Trump has done in his American first type of policies feel like longer term are more harmful to US interests than positive. And that's sort of what I think the US Treasury market is telling you today and yesterday.
Yeah, no, I think it is interesting to see some of the policies, because there's definitely, I think, a point of no return on the path we were on. And so something needed to change, but it's pretty hard to game out like what that change needed to be. And we're kind of on this path now. We'll see where it goes, but I think it'll be definitely interesting to watch. But before I start to let you go, I do want to ask about the firm you're launching, which, if I remember right, is called or going to be called Brumby Capital. I'd be curious to hear the story on that, what your plans are, and kind of where you think that's going to go.
Yeah. Okay. So it's called Brumby Capital. Brumby is an Australian wild horse. I am Australian. I am wild. And the horse comes from the firm where I used to work, which is Horseman Capital. And it got quite well known, being republished on Zero Hedge. I don't know if anyone reads Zero Hedge anymore. I think they do. But and so, I ran, basically a hedge fund for like 15 years. A lot of the strategies I used to use were based on the old free market world that was in existence from 1980s onwards. And they really stopped working in 2016 under Trump. So I gave back money in 21, been writing my Substack. And then I started to think I was working out where the new rules would be in this world. So to give you a good example, in the old days, if I thought we were heading to like a sell-off in the S&P of like 20%, I would be long treasuries. Like I'd be long treasuries massively, because that would be the perfect environment to be long treasuries. In this new world, I think treasuries are not a buy. The opposite of a long, if that makes sense. And it took me a while to work out why. And I think what I found out was just politics is the driver of everything. So, I'm going to launch a new fund, sort of looking at these new rules. I think the rest of the world is a little bit slow to catch up with. I think there's like a business opportunity and an investment opportunity there. So it looks attractive, I think. And I talk about it on my Substack. So if you want to know more, just come and look at www.russell-clark.com.
Yeah, I think it's pretty interesting because a lot of the things you've talked about, like I see similar trends happening, and I think a lot of people get caught up in like the next month or next 3 months. And I think taking a step back and zooming out is like, where are we going over the next 5 years, like 10 years? Like, where is the general direction of things? And you see like how tied in politics and geopolitics is going to be with financial markets. I think it's definitely, we definitely live in interesting times, is I guess the way I'll put it. Before I let you go, I do have to ask my traditional closing question, which is, what book should I add to my reading list? Can be history, finance, investments, or just anything you think I'd find interesting.
Yeah, the book I always recommend to everyone is my favorite sort of history book, which is a book called Age of Extremes by Eric Hobsbawm, who died a few years ago. He was an economist economist/historian who believed you could only understand the 20th century through the rise and fall of the Soviet Union. And he makes some interesting observations that the pinnacle of the US, which was sort of like 50s, 60s, 70s, and 80s, was driven by fear of a Soviet Union. So the government in the States in that period was desperate to make working class as prosperous and as happy and as safe as possible to sort of reduce the attraction of socialism. And so he worried that when the Soviet Union collapsed, greed would overtake US government and start to cause more negative outcomes. And he wrote this back in early 2000s, late 1990s. And whenever you read this book, you think this guy was so prescient on where and how US government was going to change over time. And I always wonder what he would say about the world today and where we're going to go. I imagine he'd be quite bearish, at least socially. I don't know. I don't think he cared about markets, to be honest with you. Anyway, it's a fantastic book. It's a difficult and it's a very long read, but you learn a lot from it, and I recommend it to everyone.
Yeah, no, I think even the people that looked at kind of the trend of things from 20, 30 years ago, like Yuri Bezmenov and other guys like that, I think they'd probably be surprised at the state of culture and state of politics, like all these different things, where I look at it, I'm like, okay, this is definitely an interesting setup as far as like cultural cycles and all this other stuff you kind of see playing out in real time. But I think there's no stopping the cycle, and it's not just in financial markets, and it plays out in culture, politics, other parts of history as well. But I know you mentioned the Substack. Is there anywhere else that readers can look for your work or may find you on social media?
Well, I used to be on Twitter, or X, but that's turned into like a a cesspool of like awfulness. So really, is a Substack. I do, yeah, I do some stuff on LinkedIn and TikTok, but Substack's where I do most of it. I like Substack; gives me more control over any ads and also how you see me, and I get more feedback on the people reading my stuff, so I can give them more of what they want if necessary. So that's the best place to look for me.
Yeah, no, it's definitely worth a follow, and I do enjoy listening to like the 5 or 10 minute quick hit audio listening kind of mini podcasts where you get a lot to think about, and it's always like big picture stuff. It's not just what the markets did today. So I find it fascinating. You guys should definitely all go follow his work. I think you definitely get some food for thought there. So I think with that, we'll be wrapping up. Thanks for stopping by, and we'll see you next time.